Hey everyone, how's it going? It's Kyle. As Todd probably already mentioned, we're recording separately this week, and then we're gonna combine our segments to go out as one video. And here's our disclosures in case you missed them. Past performance is not indicative of future performance. Um, and then a lot of other good disclosure information here that's important to read.
Hey there, traders. Todd Gordon of Inside Edge Capital. It's Sunday night, August 17th, and I just want to do a quick update on my end, just on the market side. And then I'm going to splice in Kyle's good contribution that he recorded Friday and put it together for hopefully a cohesive update for you as to what's going on in the markets, the economy. So other than that, all's well. Markets are quiet. We've been enjoying some summer, which has been good after the big wind down, sunsetting of trading analysis and the wind up of Inside Edge, which has been great. But we're all trying to catch a little bit of summer here before we go into a strong close to the back end of the year. But everything is good. Markets are quiet. I have a few themes that I want to bring up to you, more technically based, because Kyle went over a lot of the Fed policy, tariff updates, did a really good job. And he also went deeply into Social Security. Kyle's been doing some really, he's our head of financial planning, but he's been doing some really good content with the planning side that people are really interested in. Last week he did trusts, and we had a couple of people reach out and a couple clients, prospective clients set up meetings based on that. So it's really, really important. And, as you guys know, it's a combination of active portfolio management, risk mitigation, trying to generate as much excessive return as we can on the upside while protecting in the inevitable, bouts of volatility and drawdowns, combined with a good, solid financial plan that you can fall back on that helps you get through the bouts of volatility while, I'm doing my end to protect the portfolio. But, if you have a good squared away financial plan and you have everything laid out, gives you the confidence to see your plan through to completion. So it really works well together. So again, I'm going to kind of mail this one in a bit. The markets are quiet. We're in the tail end of earnings season. The market sold off just a little bit on Friday. I'll show you where we are. I'll show you a theme or two that I'm seeing. We're coming in some earnings, specifically from the big retailers, Home Depot and Walmart. But not a huge takeaway on my end, so I'll just be quick and splice in Kyle's video, and we'll be back on a normal schedule here coming up with two weeks left of winter, or summer, which is crazy before we head into winter. So here's the market. The right here, this is the S&P 500 tracking stock SPY. You can see we had a little bit of a down day there on Friday, preceded by Thursday. An up day, Wednesday, sort of an indecision cross kind of pattern. So no big deal. We're still at all-time highs. We've recovered after that July 31st and August 1st sell-off. We've recovered right back up, and now we're consolidating at the highs. Okay, so really not much to report on. That's the S&P. Here's the Nasdaq. The Nasdaq did have two down days. So Friday was a down day by that red bar, and then Thursday was as well. Wednesday was a nice up day, but it was a reversal, right? So the hash is on the left side of the bar, which means the market opened here. And then by 4 o'clock on the close, it was on the hash that exit out to the right. So it's marked as an up day because we're higher than the prior close. But then, as I said, Thursday, Friday were two down days. So a little bit of sideways consolidation. But I think the point remains is after that July 31st, August 1st sell-off, and then we recovered everything, then shot right back up to the highs. Like, that's how the market works. Like, it's basically 3 steps forward, 2 steps back. Though lately it seems to be like it's more like, how about 4 steps forward, 1 step back, 4 steps forward, 1 step back. And that will change at some point, but the market is so incredibly strong right now. Okay, so just kind of going through some other, I call them macro markets. This is the IWM. This is the ETF that tracks the Russell Small Cap 2000 index. So, it was a good weekly breakout here on the left. Every bar here is 1 week of trading. There was the sell off at the end of July, a little bit of an inside week, and the first week of August, a little bit of indecision. Then we closed up out of this range, the ceiling of price that was in place from June to July. And same thing, good move up on August 13th, and then the 14th was a down day, and then August 15th was a down day as well. But, a lot of indecision. What am I seeing? TLT here, this is an ETF that tracks 30-year treasuries, U.S. treasuries that have 20 years of maturity left, 20 years or more until they become mature. So basically, it's an ETF that tracks the 30-year bond. U.S. yields go up, that's going to have a downward pressure on the corresponding bond and the ETF that tracks the bond. So what that means is, this TLT ETF is going down. That means the corresponding yield on the 30-year interest rate goes up. Of course, it's the 10-year yield on the shorter maturity 10-year yield that is really the heartbeat and the barometer of interest rates in the U.S. with mortgages and housing and capital goods loans and credit cards and all that. But what I'm seeing here a little bit is the TLT's been dropping since August 5th. Here we are now, August 15th. So it's mostly been down, which means that the yield on the 30 years gone up a bit. Okay. Generally, that would put an upward pressure on the dollar. The higher our yields are, the more attractive U.S. assets are to overseas investors, which would bring foreign flows out of foreign currencies buying U.S. dollar to buy U.S. goods or higher yielding products or securities. It's not really the case. The dollar, as measured by the UUP, which is the ETF that tracks U.S. dollar, has been going down through most of August. And contrary to what you might think, a lower dollar is actually good for the stock market. So, I take it as a good, even though TLT is dropping, U.S. yields are going up. That usually corresponds, I would say, in more liquid, active market times, not in August, with if yields going up, dollars going up. Usually that's bad for the stock market. Well, we have yields going up, the dollar going down, stock market pretty much at all-time highs, though we had a sell-off over the last day or so. And gold has been, this is the GLD, the ETF that tracks gold, just completely sideways since April. So it's not a whole bunch going on right now. That's the Vanguard Growth ETF, VUG. It's going to look alike to NASDAQ. So, Friday, a little bit of a sell-off. Thursday was fine. Wednesday was an all-time high. So there's really not too much to report. Let's take a look at earnings this week. So this is everything has earnings from August 17th to August 24th, market cap above $2 billion, and a US-based company. And the big ones, I have them sorted by market cap. I can take that off for you if you like and just sort by earnings date, which would be like that. So tomorrow will be Palo Alto Networks. That will be an interesting one. Look, the stock's doing very much lately. Surprising. Well, this one sold off pretty good here in August, from 207 down to 167. That's pretty good wipeout there. This is the weekly. There's the daily. Okay, and then the 19th, which is Tuesday, is going to be Home Depot. Toll Brothers reports on the 19th. Analog Devices, S Technology. Estee Lauder, which is a consumer staple. Here's Lowe's, Target. So what I'm going to do now is I'm going to sort by market cap, and you're going to see the theme of stocks that are reporting this week, not sorted by date, but sorted by market capitalization. Walmart is going to be the 21st. Walmart has been trying to break out to new highs here through 105. It was on approach of a breakout in the first week of August, and this week sold off. Profit taking ahead of earnings, maybe. Could also be that move down in TLT and that move up in yields. Generally, that's viewed to want to hurt the consumer. So it's interesting this week, Walmart backing off of that double top with U.S. rates going up a touch. Fed not cutting. It's very much related. Home Depot broke out nicely last week. Is interesting. Very much a different direction than Walmart. So this is the weekly. Nice breakout in Home Depot. That was the high on Wednesday, Thursday, Friday, with a little bit of a profit taking. But all in all, very good. Home Depot. You could see we can go to quarterly earnings. This is going to be GAAP earnings, generally accepted accounting principles. So we're looking for, it should tell me when the, oh, I just said it, August 19th. So GAAP earnings are looking for 465 on 45.40 billion in revenues. And get out of here. And that would be a 1.09% increase at 465 from the same quarter, which is Q2 of 2024. So they made $4.60 in the same quarter last year, looking to make 465, which would be a 1% increase on 45.40 billion in revenues, which would be a 5% increase from revenues. So call it, I'm just going to guess 5% of 45 billion would be 42 and a half something billion, something like that. 43.17, so close. So moderate looking growth, but a nice move up in Home Depot despite that move up in rates. Okay, I'll come back into it again. Boy, some of those tech stocks sold off pretty hard. This stock has been going well, but TJX companies, including TJ Maxx, again up in the highs, kind of similar to what Walmart was doing. Home Depot's on approach. Lowe's is going to be August 20th, a nice move up. So I think that what the takeaway that I'm seeing, you look at some of the housing stocks, they've started to come back, even though that, let me go back over here to macro, TLT, the rates, have been going mostly sideways over the last 3-4 months. Housing stocks were under pressure on the idea that the Fed was not going to cut rates. But it seems to be that if I were to go over here, so Toll Brothers is going to be coming out August 19th. And then if I went over here to consumer discretionary, which where all the home builders are located, and I had them sorted for you: automobiles, automobile components, specialty retail, hotels, broadline retail. Where'd it go? Seven industry. I had it built for you right here, home building. Okay, so I'm going to just kind of click through some of the home building stocks. Okay, Top Build Corp. Again, this is the weekly chart. Each bar represents 1 week, and this is the daily chart. BLD coming on pretty good. Cavco also trying to break out. Dreamfinders Homes. I don't know this company. It's a $2.6 billion market cap. Looks interesting through that 2930. That's a new one for me. DR Horton, of course, we know that one. That's a $49.3 billion home builder. But look at this thing, ripping. Home builders are coming on. Green Brick, another one. Installed Building Products, that thing is ripping. KB, another builder, coming on the last couple of weeks. Lennar, right there. MHO, Meritage. You're seeing a theme with these home builders. So, what does that mean? I don't know yet. I don't think it's the market. I don't think it's the market trying to discount rate cuts. The home builders loosening up. Is it a regulatory issue? I have to plead a touch of ignorance. As I said, I'm kind of mailing this one in. I've been doing a little bit of summer relaxation, took a couple days off. So it's a theme I'm seeing, and it's interesting, as I mentioned, with Home Depot and Walmart, two biggest retailers out there, with Lowe's and Toll Brothers also reporting earnings. It'll be a good read on the state of the consumer as it pertains to how we're going to deal with the probability that Kyle is going to talk about as I splice this video in, as to where rates are going to go. And the market is just kind of positioning themselves around that. So I don't have a clear takeaway on that. Again, was kind of taking a few days off in the summer. I've got to get a little bit caught up, but markets are in pretty good shape. So we're still good. Over on Active Opps that we cover in Savvy Trader, we're still holding a half of a position in VIX, which is losing money, which is the hedge, but we still have a strong portfolio coming on and things look good. So other than that, I hope you're enjoying summer a little bit. Just wanted to do a quick little video, and I think the kids and everybody have voted to go watch Dumb and Dumber. My 6-year-old sister thinks that movie's a riot, so I think that's what I'm going to go watch now as soon as I put this video together. All right, I'll talk to you guys soon. All the best.
Today, I wanted to do an economic and tariff update. We had some news this week, and then do a quick primer on Social Security planning. This is in light of some changes that happened this year with Social Security with the tax bill. So, starting off on economics, the CPI and PPI inflation numbers came in. The CPI measures more end product consumer inflation. This one rose at 2.7% clip, less than the 2.8 expected. PPI, which came out later, made it the inflation picture more of a mixed bag, as it actually had inflation rising more than expected, 0.9% above the expectation of 0.3%. And both of the rates, the 12-month rates, are still slightly above the Fed's target, which is 2%. Once inflation goes down to 2%, that's an argument for the Fed to reduce interest rates. And so it's interesting to note that the chance of a cut of interest rate cut is actually quite high right now. This is the rate probability or probability of rates being cut a little over a month from now at the next Fed meeting. And the current odds are 88.6% of a rate cut. So we're still a month out and a lot can change until then, but if you look, I mean, if you look a month ago, this it's going to be over here in the bottom right. You can see there was basically a 50-50 chance of either keeping rates the same or cutting a month ago. So a lot can change, but it's not, not unrealistic to believe there might be a rate cut of 0.25% here in a month. Uh, on the tariff front, tariffs were extended. There was a deadline extension of 90 days, and that happened earlier on Monday of this week. And it was hours before rates were going to go from, on goods from China to the US, there was going to be a tariff rate of 30%. And then China had retaliated with a 10% tariff on US goods shipped to China. So this extension pushes those tariffs out another 90 days. It gives companies doing business in both countries time to plan and lobby and just prepare and update their supply chains to mitigate the risk of tariffs. So a business friendly move, I would say there. And where's my mouse? Here it is. Also on the geopolitical front, today, this Friday, President Trump and President Putin are having an in-person meeting in Alaska to negotiate the end of the Ukraine conflict. And I bring this up, Russia or the West has had sanctions on Russian goods the past couple years since 2022 um, due to the conflict in Ukraine. And so from an economic perspective, this meeting probably isn't going to mean much in terms of Russia-US trade, but what it could do is affect the US stance towards China and India. I have two copied headlines here with information about secondary sanctions or additional tariffs on countries that do business with Russia. And both India and China purchase a ton of Russian oil. So this would be something that I would be watching this meeting today, not just with hope that there's some resolution to the Ukraine conflict. Definitely want that to happen, but more with the hope that um, we get some clarity on what sanctions changes are going to happen, if any. So switching gears a little bit on, that was the economic and market side. Now I want to get into a little bit on Social Security and talk a little bit about planning for Social Security. So this first slide is titled "The Benefits of Delaying Social Security," and I I would say that generally speaking, I'll get into some things that some considerations that you should certainly have, which may make you want to file earlier. But it's generally advisable for healthy individuals with stable finances to wait until their full retirement age, which is age 67 now for people hitting full retirement age this year. It used to be 65, but it's generally advisable to wait. Um, every year that you do wait, it's going to add 8% to your benefits up until age 70. Claiming benefits early, it reduces your lifelong payout, and it also gets taxed if you're still working. So, in terms of filing early, there are some factors that would lead me to recommend filing early. Those could be health, marital status, amount of savings that you have available to supplement your expenses, and those are something you definitely want to talk with your spouse, talk with your advisor, and come up with a plan that makes the most sense to you. Lay out your priorities and make the best decision that works for you. But generally speaking, delaying it, not only does it have an 8% additional benefit illustrated by this chart on the right, but Social Security is a rare pension. A lot of company pensions, defined benefit plans don't ever do cost of living adjustments, or they're very rare and very small. Social Security does do cost of living adjustments, and they consider the higher starting benefit. So, whatever your benefit is when you file, whether it's up here or down here from 62 to 70, the Social Security cost of living adjustment for this year was 2.5%. And so, regardless of where you were, it was 2.5%. So, if you have a higher starting number and you're talking about cost of living adjustments over a period of decades or years, then you could definitely start to see some compounding in your Social Security benefits, which means that future increases um, start to be taken on your previous increases. So just to give an idea of how significant that can be. And then one more point, the benefit or reduction that you get. So like I had mentioned, 67 is currently full retirement age. The reduction for filing early or the benefit for waiting is not recalculated on an annual basis or like on a calendar year basis. It's going to be recalculated every month. So every month that you wait, you're going to get, we'll call it 1/12 of 8% more benefit. Every month that you take early, it would be a reduction of that. So, wanted to put together a profile, kind of an example recommendation of how we might work through the process with a couple here. I put that they were 2 years apart in age. The older spouse has a $3,000 full retirement account benefit, and the younger has a $2,500 full retirement age benefit. And the recommendation, in practice, we would have, more than one conversation and really, make sure the priorities, their health, all line up with these recommendations. But generally speaking, this is a recommendation that I would issue, which would be that the higher earner delays claiming to age 70 to maximize their benefit and the survivor benefit that their spouse would receive should they pass away first. With the younger spouse with the smaller full retirement age benefit, claiming early if they aren't working, or if their own benefit is less than 50% of the higher earner's full retirement age, which in this case it's not. You can see up here the full retirement age benefit is not less than half. And the reason that that would come into play is because there is a way to claim on your benefit. And then when you hit full retirement age, say your benefit is less than 50%, what you could do is claim early, take the smaller benefit, which would be yours. And then when you hit that younger spouse hits full retirement age, switch to a spousal benefit and get 50% of the higher earners full retirement age amount. So you can file on yours and then switch. A lot of people don't know that. Keynote, the higher earners delayed benefit, as I mentioned, it boosts the survivor benefit, surviving spouse benefit, but not the spousal benefit. The spousal benefit is always going to be based on the full retirement age amount of the higher earner. And then here's a chart just to illustrate, there are break-even points. You've got an early filer here. They're going to spend, a significant amount of time up until age 78. They're going to be, glad they filed early. And then, assuming maybe they invested all this money and this is actually higher, but just looking at it linearly, you can see these different breakpoints. The longer you wait, the less you get up front, but the more you get later on. So, think about yourself. What's your risk? Are you worried about running out of money now and preserving, your assets and not having to withdraw from your assets to live, which might be an argument for starting benefits early? Or is your primary concern to not outlive your assets? If that's your priority, then it probably makes sense for at least one spouse to delay claiming. And again, you definitely want to have that conversation with your spouse and with an advisor who's able to help you discern what the right strategy is. Quick note on working after taking Social Security. So continuing to work, and these numbers actually are more lenient than they have been in the past, but there is a penalty for if you take early Social Security. There is a penalty for working. Benefits get reduced $1 for every $2 earned over this number, 23,400 in income in 2025. And the year that the Social Security recipient hits full retirement age, they're going to reduce the benefit $1 for every $3 over the income level of 62,160. And then after full retirement age, there's no penalty. So if you're still working after full retirement age and you're ready to file, then you don't have to worry about being penalized. So with withheld Social Security benefits, shouldn't discourage working. That's important to say if that's what the individual wants to do, because it's probably just going to be a better idea at that point to just delay benefits and just keep working until you stop working or until you hit full retirement age. There are going to be situations, say it's a semi-retirement job where your income isn't too much over this number of 20, basically 2,000 a month or 23,400. If you're pretty close to that and you have a need to file early, then it may still make sense. Again, this is all just kind of general advice. Always better to sit down and make a lot of tables and see where the break-even points are and see what makes the most sense. Um, Lastly, there's a lot of concern and attention around the Social Security Trust Fund and how it's at risk of being depleted. I added a chart here that I liked. It only goes till 2021, but what it's showing here in red is the total assets of the Social Security Trust Fund, and it's going up here. You can see it, it's very clear up until 2020 here, it looks like, and then it's gone down. And here it ends around 2.85. I do have the most recent number. It's at 2.74. I want to say trillion dollars in assets. The total income, that's the amount of payroll taxes being paid into the Social Security fund. That's here in blue. And then the total cost is, so benefits being paid out from the trust fund is here in green. So one important point about Social Security, you probably heard someone express concern. This may be you, and I respect that, but express concern that Social Security might go away entirely, or joking that you may never see anything a penny from it. Which it's important to note if no laws changed and the trust fund ran out of money around 2035, around 83% of the benefits could still be paid from the income, this blue line, from the income paying in. So that's with no changes whatsoever. And there are some laws or things that Congress could do, make changes that would fix the long-term trajectory. I put a few ideas here. None of them are really like good ideas. You're mostly either increasing the taxes or the total income, or decreasing the benefit or the total cost. Um, so the first one is increasing the payroll tax rate. There's a tax rate paid by both the employer and the employee that goes into Social Security. You could slightly increase that, and just based on the amount of assets or amount of income that people are making in this country, a small increase in that rate would be able to fund the Social Security Trust Fund and keep it solvent for decades. I mean, depending, and we're talking about 0.2% increase. You could also raise the taxable earnings cap. Currently, only the first 170,000 or so income is taxed for Social Security, and then anything earned above that is not going to be taxed for Social Security at all. So it's a little regressive in that sense, where the tax rate goes down as your earnings go up. There is a rationale for that, but really the point is, you could raise that cap slightly or entirely get rid of it. 100% of your income is taxed for Social Security, but that is an option. You could freeze benefit increases based on where the trust fund is. You could put in a formula. This one probably too unpopular to pass. There's I don't know many politicians that would probably support this, maybe a couple. And then the last idea I had was just various initiatives that could broaden the working contributor base. There are um, exempt employees, state and local employees. You could have newly hired state and local employees start paying in, increasing legal immigration, getting more people paying into the system, and or like another, and I'm just kind of throwing things out, or another would just be like increasing or doing some stimulus that would increase the total amount of income being earned. So just my ideas. There's no perfect answer. And lastly, just how to decide when to file, given what we were saying about Social Security solvency. I would personally avoid recommending collecting early based on fears of social security solvency. Like I said, I mean, they could change nothing, and you might see a decrease in the future of 17%. So um, that's a far cry from social security going away for good. And instead decide when to file based on, what your budgetary needs are when you do reach eligibility to file. What are your goals? Is it to cover expenses now? Is it to not outlive your money later on? Think about what's important to you and use that to guide your decision. And then also health and longevity. If you have a lot of longevity in your family, maybe wait if you're more concerned about your health and you're being around decades from now, then it may end up making more sense to file early. Like I said, that um, chart had a 78 years old break even on filing early. So, it's not terrible to file early if you decide. I mean, you worked hard for that money and you earned your benefits. So, and at the end of the day, you're getting it. Could be years head start of receiving benefits if you take it at 62 versus at age 67 or age 70. So yeah, that's all I have for today. I'll send it back to Todd, or maybe this will conclude our stream. I don't know how he's going to set it up yet, but I very much appreciate y'all tuning in and look forward to catching up with all of you next week. Have a great weekend. Talk soon.